You're listening to Carrie Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network, and I'm Carrie Lutz, and today is 2/9/22. Well, metals prices, it looks like 1,800 is the bottom every time it goes below, and it's done that 6 or 8 times since I've been watching. Within a week, metals prices, gold prices rebound higher. Silver, it's looking like 23, 24. We're hitting that physical floor. The question is, with all the inflation, with everything else, when are the prices going higher, at least in nominal terms, in terms of dollars, which is what we all use to buy them? And with us is our good friend, Andy Schectman from Miles Franklin Precious Metals Investments. Andy, it's great to have you back on. So what gives here?
Always good to see you, Carrie. Thanks for having me, buddy. I don't know what gives. We have the Buffett indicator showing markets are 210+% of GDP. That's over 60% higher than the long-term trend. We have Jeffrey Curry, our friend from Goldman Sachs, saying that in the 30 years he's been doing this, he's never seen shortages like he's seeing in every commodity from oil, gas, coal, copper, aluminum, on and on and on. We see the huge drawdown of gold and silver coming out of the LBMA and the Bank of England, over 26 tons of gold and over 600 tons of silver taken out quietly. We're seeing big drawdowns out of the back end of SLV and GLD. These means of taking the metal out sidestep reporting requirements and allow big money like commercial banks and sovereign wealth funds and maybe even as far as central banks. It allows them the ability to de-dollarize without the light shown upon them as to what they're doing. It allows them to accumulate under the cover of protocol that isn't enacted the way that it would be if they were to draw it off of the COMEX. We're seeing difficulty getting product right now, Carrie. It's getting harder than it's ever been, ever. All of a sudden, it's gotten really hard to find product. So we're starting to see supply chain issues again here in this industry that I think really we haven't even seen the tip of the iceberg yet. I don't know. We got a $30 trillion debt, which is 25% larger than the entire U.S. economy right now. We're a country that seems to have, lost its way. We surrender tens of billions of dollars of military equipment to the Taliban. We're embracing socialism and vilifying capitalism, which created all of this wealth to begin with. The opposite of capitalism. And, I don't know. It just seems there's so much divisiveness right now in black versus white and red versus blue and rich versus poor and vax and no vax. And I don't know. It seems like, what you're seeing in Canada is emblematic of what we're all feeling. We've had enough. And I think the mandates are just kind of the icing on the crap cake, where people just want to go back to their lives, want to find a way to get back to normal. And I think on top of it all, you have a situation where inflation is running rampant, and a Fed who's telling us that they're going to get tough on inflation, and they're going to, as we've talked about, they're going to not only raise rates in March, beginning of up to 8 or more rate hikes over the next 2 years. They're going to pare down their balance sheet, stop purchasing the $130 billion a month in treasuries and mortgage-backed securities, and even shed their balance sheet. One of the things that I found very interesting recently was Powell's admission that he wants to only hold treasuries on their balance sheet. Now, the Fed can hold treasuries and Fannie and Freddie securities. So they're Fannie and Freddie. They're going to dump what is in excess of $2.7 trillion in mortgage-backed securities onto a real estate market that is already seen just by the 40 basis point increase in the 10-year Treasury, has already seen a 10% reduction in mortgage applications this month. Now, they say that every 1% increase in yields translates into up to a 10% or more decrease in home value prices. Well, the Fed gets its way and raises the interest rates to 2%. That's a 20% haircut on a market that is massively overvalued. You start to see Fed dump $2.7 trillion in mortgage-backed securities. You could see a bloodbath in the real estate market. That could be the tipping point that pulls down with it. Other markets don't know. But I think these are very interesting times where there's so much going on in so many different ways. People are starting to I think get a little bit anxious, if you will. And I wish I felt this was just the end of it, but I believe it's just the very beginning.
You could well be correct, but there is hope because the administration is providing $30 million so that nonprofits can hand out crack pipes. So I was very encouraged by that, Andy.
I was watching that on Fox last night, and they showed a snippet of Biden when he was in Congress talking about a bill that he introduced that if you're found with a piece of crack the size of a quarter, he held up a quarter. He says, you go to jail for 5 years, no matter what. And the judges have no power to change that. It's no matter what. You're found with a piece of crack size of a quarter, you're going to prison for 5 years, period. This was back in the 90s. And now he's such a flip-flopper that he's actually subsidizing and passing out crack pipes to the public so they have something safe to smoke out of. I saw that. It was unbelievable, just emblematic of the craziness that is our government, which even brings me to something else that when we talk about crazy, I don't know if I've ever seen anything so crazy as a little video that I saw by the lead economist at the St. Louis Fed, and it's titled, Does the National Debt Matter? And this was just the other day. I saw it. My friend who runs Chris Irons, who runs the Quote the Raven podcast, sent me this. And it says, the gentleman gets on and says, people view household debt or view the national debt from a household perspective. And he said, that's not right, because he said households have a finite lifespan, whereas a government has an indefinite lifespan. So a government never really needs to pay its debt within a finite period of time. It says roll it over indefinitely. And he says, and treasuries represent a claim on U.S. dollars. And because the government can print U.S. dollars, there's never any economic reason where the U.S. government could not pay back its treasury its treasury obligations in newly printed U.S. dollars. And I went on to say even further that the national debt represents a liability, shows up on the balance sheet, but it represents an asset elsewhere. It's a liability against the government, but it's an asset in your pension and your life insurance policies and whatnot. And this is not a burden on our children because it corresponds with an commensurate increase in the household wealth of the country. I mean, we're so far gone in so many ways, whether you're passing out crack pipes or saying a $30 trillion debt is not a drag on our children or future generations, or that the government can just roll over its debt indefinitely because of its indefinite lifespan. These are just absurd, obscene statements come from a government that is embracing socialism, it seems, or an establishment vilifying capitalism and spending us into oblivion through modern monetary theory. It's insanity to me, Kerry. And these are the reasons that I personally own precious metals, because I think we've lost our bearing in many ways. And I think the government will most certainly try to rattle the bushes by raising rates. And then as soon as the market starts to go through massive convulsions, they're going to flip-flop and reverse course. They're going to do what all other administrations have done forever. And they're going to jack up the printing press, and it's going to be inflation from here until the ship breaks.
I'm inclined to agree with you, when you think about it, what choice do they have? Once the stock market really bombs out, that's kind of the end of it. That's, it'll take real estate with it and everything else, won't it?
Yeah, and you have such massive overvaluation in real estate because of all of the speculation by the hedge funds and companies like BlackRock, who take all of this easy money that's been given to them courtesy of the Fed, and they invested in things. They financialized the real estate industry. and they're buying up properties all over the place, jacking up the values of properties. Where in cities like San Francisco, you have such massive homelessness and huge problems where they're going to be handing out, safe crack pipes and having safe zones to shoot up heroin they were talking about the other day. And you have real estate prices at all-time highs because of the as we've talked about before, the misallocation of resources. And this is the crack up boom that Austrian economics talks about. And when the public realizes that, we may have realized it, but when the public realizes that the Fed has painted themselves into a corner, that they can't really raise rates and get tough on inflation because they will blow up everything. All of the pillars of wealth in this country, stocks, bonds, and real estate, are inversely correlated to a rise in rates. If rates rise, it brings everything down with it. So I think when the public realizes that they're damned if they do and they're damned if they don't, that's when the bond market is really going to go through convulsions. When people start running from the U.S. Treasury, which was once considered the safest investment on the planet, we realize that the political and the market risk of holding a bond that, even with rates approaching 2% on the 10-year Treasury, is still 5% negative in real terms. I think that's when things get really, really, really crazy. And when the public realizes that the Fed is out of options, that's when they lose control of the bond market. And when the bond market starts to tank, it kneecaps the stock market and obliterates the housing market. These are realities. And so either they confront that reality very quickly, or they reverse course, which I think they will, and start papering things over again. But this is just going to lead down a more painful road in the end. In the end, Mother Nature will get her way. She'll get her pound of flesh one way or the other. And I think that we would have been better served to go through the pain in 2008. We'd be long on our way to recovery. Instead, they've just coiled the spring even more. And when it pops, it's going to be awful. I really do believe that. I think that you have such absurd valuation in financial assets and no price discovery. And when it finally starts to find an equilibrium between risk and return, asset prices have to be markedly lower from where they are right now. And that day is coming. Either that or we're going into Weimar Republic hyperinflation, one or the other.
Yeah, well, that's the tightrope that they're walking, Andy. And really, as you so artfully illustrated, they really have no choice. Something has to give at some point. And, what it's going to be, where it's going to happen. That's what I want to know. But nobody seems to.
Well, no one does know, but people are wondering, where's all this inflation coming from? It's not just the fact that 50% of every dollar ever created in the history of this country was done in the last 2 years over COVID spending. It's not the 2019 repo market where they're putting in up to $1 trillion a night into the repo market, bailing out the banks without officially saying that. The predating of all of this is the 2008 financial crisis. The Levy Economic Institute, through Freedom of Information Act, all the way to the Supreme Court, just unearthed records that were sealed for 12 years that the Federal Reserve challenged all the way to up to the Supreme Court. And Levy Economic Institute actually brought it to the public through the Freedom of Information Act. We were told in 2008 that $700 billion went to TARP, $700 billion went to the infrastructure. It was that 1.5 trillion that created the Tea Party, for God's sakes. It was then another $3 trillion, we were told, that bailed out the banks. But when this report was just released that was held sealed for the last 12 years, we find that the number was $29 trillion, that banks all across the spectrum were receiving trillions of dollars, including Citibank, who got $2.5 trillion, which was in essence nationalized by the federal government. And they are part owners of the New York Federal Reserve. Do you see the incestuous problem in all of this? Not just that, spending money with banks all around the globe, where now we've exported our inflation to the point where the United Kingdom has the highest inflation that they've had, since last 30 years. You have Germany with the highest inflation since World War II. You have the highest inflation in Japan in the last 2 years. All of the money that we have created and exported has created inflation all around the globe. So when the shit hits the fan and everything collapses, we won't just be in big trouble. We'll be universally hated for the pain that we have inflicted upon the Western world. And so, I hate to paint such a gloomy picture, but people wondering where the inflation came from. Our government has chosen the printing press over austerity. If they would have let things break apart and Mother Nature cleanse the whole system, which has to be done at some point, if they would have let that be done in 2008, we would be long on our way to recovery. But as it is right now, we have that ahead of us. We have to find a way to find price discovery. We have to let interest rates be set by the market, not by the bankers. And when that happens and interest rates and asset prices find their equilibrium, it'll be a lot lower than it is right now. So the question is, does the Fed stay true to its word and get tough on inflation, sell off $2.7 trillion in mortgage-backed securities, stop purchasing U.S. treasuries, raise interest rates? And if the answer is yes to that, then we got a long road ahead of us. If the answer is no, just enough until the markets freak out and then we'll reverse course, then it's going to be more of the same. And we're well on our way to massive inflation with greater supply chain problems that won't go away for the foreseeable future. In either case, owning precious metals as wealth and not as an investment has never been more important, and it's also never harder to get. So I think we are entering that period of time where, as the Chinese curse says, may you live in interesting times. These are getting interesting, Kerry.
That's for sure. Hey, I wonder how much the Fed paid to bail out all the world's banks during the pandemic. If they paid $26 trillion during 2008 and 2009, you can only imagine how much it cost this time, because this was a global financial collapse where banks were ready to keel over here.
Don't just survive, thrive. The Financial Survival Network.
Doré Copper Mining is a premier, near-term, high-grade copper and gold redevelopment opportunity with tremendous exploration potential only 14 kilometers from the town of Chibougamau in mine-friendly Quebec. Doré Copper is debt-free and owns a 2,700-ton-per-day mill with an 8 million-ton tailings facility ready to be used. There is already power to site, and it is accessible by paved highway and rail. Doré Copper aims to produce a profitable hub-and-spoke operation of over 100,000 gold equivalent ounces per year, or over 60 million pounds of copper equivalent by 2024. Because of the existing infrastructure and location, a low capex is anticipated to recommence production. Doré Copper trades under DCMC in Toronto and under DRCMF on the OTC. To learn more, go to dorecopper.com. That's dorecopper.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
Yeah, that's why you were seeing $1 trillion a night in the repo market. They were bailing them out without reporting it. Those numbers will come out at some point, maybe 10 years from now, like the 2008 did. But you're right. That's exactly what they've done. They've papered over the problem. They've bailed everything out, and that's created the misallocation of resources by the misallocation of capital. And that money that was just created with the keystroke used to bail everyone out has created massive bubbles in financial assets. And there will have to be a day of reckoning, or interest rates stay low forever and inflation eviscerates what small value the dollar has left.
Hey, it's really kind of shocking. But, they only have two rules at the Federal Reserve. When in doubt, print. If still in doubt, print more. That's really it. That's their playbook.
Well, Richard Russell always used to say, inflate or die, that they have no choice but to inflate or default. And in reality, when you realize we have a $30 trillion debt and over $100 trillion in unfunded liabilities, Medicare and Medicaid, Social Security, government, military pensions, all accumulated in what is, in essence, the lowest interest rate environment in history, that's a problem. And that's why, every 1% interest rate hike equates to $300 billion in just an interest payments alone. And at some point, just the interest payments alone on the national debt would take all the tax receipts. So, we are at a point where the Fed is out of options. And I really do think that at some point when this realization hits mainstream is when things get really, really interesting, when everyone starts to sell their bonds. And, it's interesting because who holds the bonds? Well, the pensions hold the bonds, the insurance companies hold the bonds. So when you talk about an implosion in the bond market, it's not just sequestered to the bond market. You have a lot of the household wealth, all of these pensions that are so already underfunded will just blow up. And so you're talking real problems. You're talking depression. You're talking, if you think there are social problems now, just wait until the markets blow up and take the pensions with it. And, it's the average Joe and Jane that own the pensions too. A lot of these state-sponsored pensions and companies like International Paper, these big corporations that used to offer pensions that don't anymore. One of my good friends just retired from IP just a year ago, and he makes $150,000 a year for life. Well, how many of those can continue in this environment when things blow up? That's when you see real problems. And I think, unfortunately, I don't like to be doom and gloom. I'm a happy guy. I try to find light in a dark room. I try to find optimism. But I'll tell you, there's a very fine line these days between pessimism and realism. And when you see heads of the head economists at the St. Louis Fed tell us that debt doesn't matter because the lifespan of the government is indefinite, we can just continue to roll forward, and that debt doesn't constitute a burden on future generations. I wonder where the hell are we? I mean, it's like the Twilight Zone. Yeah,
we're in the Twilight Zone, the economic Twilight Zone, right?
Yeah, really. Well, you look, as it is right now, you got the Buffett indicator, 140% above the GDP. This is not, 200% above GDP. This is not how. This is not an environment where you see growth and where you see strength. This is a market that is wickedly overvalued by every single metric, let alone the bond market and the real estate market. So as interest rates rise, things are going to get really dicey. The question is, does the Fed stay true to its word? I guess we'll see in March, or the beginnings of it in March, how far they're willing to take this, and then what happens once it starts to break apart. These are realities. Raising of interest rates will really start to shake the financial house of the United States, really of the whole Western world, and we'll see how far they take it.
That's a good question. In the past, they've always backed off because, originally I like to say the Fed had two responsibilities. Initially, one, which was assure that prices remain stable throughout the economy. Then they picked up another task, which was to help ensure optimal employment throughout the economy. And now their third function, which nobody ever gave them, but they just took on their own with the acquiescence of Congress and the political class, is never allow the stock market to go down. Now, under the best of circumstances, number one and two, prices and employment could be in conflict. But when you throw into the mix, never allow the stock market to go down, it's all in conflict.
Very much so. And it's created this K-shape that we talk about, where the rest of the world is having a hard time making ends meet, and the wealthy have been enriched by their equity portfolios, their real estate portfolios. And this has created part of the not the dichotomy so much, but I think the disunification of this country, the separating of this country between those who have it and those who have nothing. And at some point, I guess people just need to realize that we're not living in a period of free markets, and the markets are being controlled and manipulated and to the benefit of the very wealthy. So will they follow through and let the market collapse? This mantra that's been for the last 15 years that we've seen, that the market can only go higher, I guess we'll see. But I'm not betting on it, to be honest with you. I think they will choose the way that all administrations previously have. They will choose the printing press over austerity. They will not sacrifice the markets. They'll sacrifice the dollar. But I do think they'll hold true on their word, and they'll raise rates over the next 2 years, just enough to really start to shake the markets. And then they'll come running back in. But ultimately, what does that do to the value of the dollar? It obliterates it ultimately. And if not, we're heading into a depression. So, heads you lose, tails you lose. This is why you need to mitigate your exposure to the dollar. Start to sell your equities when you have a rally. Instead of buying on the dips, you sell on the rallies, and, reposition the way that the biggest money in the world has been doing for the last couple of years. Get out of harm's way. Don't sit there and wait for this correction that is going to happen. Now they may come back in and rescue it, but they may not. Maybe they are going to get tough on it. Maybe this is the beginning of the reset that everyone's talking about. Don't know, but all I do know is that we are at the tail end of a historic bull run that if rates rise is going to create havoc to a degree that people in this country are not used to seeing.
That we've never seen anything like in the past, have we?
No, we haven't.
Yeah. Well, a little bit scary, but somehow we'll figure out a way to get through it. We always do. I like to say, quote Will Rogers' old saying, ignorance got us into this mess. Ignorance will get us out, right?
Let's hope so.
Yeah. So, Andy, hey, just tell us how we order precious metals from you.
Send us an email at info@milesfranklin. Please put the Financial Survival Network in the subject line. We'll make sure you get the best price in the country. Personalized service. We'll send you a current inventory. And any questions can also be directed to myself personally, Andy at Miles Franklin or info at Miles Franklin, and we'll get right back to you and make it a good experience.
All right. And I can say I've been buying metal from Andy for many, many years now, and always been a positive experience, always come timely. And sometimes it arrives and I've forgotten that I ordered it, and there it is waiting for me. So can't say enough good things about Andy and Miles Franklin, and been great working with him over the years. Hey, got a question for Andy? You can always shoot me an email, kl@kerrylutz.com. Don't forget, go over to Financial Survival Network and get a free weekly e-newsletter. Andy, we'll talk to you again soon. Thanks so much for stopping by.
Stay well, buddy. It's always a pleasure. I look forward to seeing you again next time. And stay well, Kerry. Good to see you, pal.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.